Hey everyone, and welcome back to the channel. My name is Hamish Hodder, and today, of course, we're doing my investment portfolio for the month of April 2019. So in April, I had the biggest month that I've had in the portfolio for the year, massively outperformed the market in the US and Australia. And of course, I've outperformed the market every single month this year. So that's the fourth month in a row. And I'm excited to share with you the details of those performances. And of course, that means that we're going to start by going through the cash and equity positions that I have, and how that's changed over the past month, and the reasons why it's changed, and why I'm holding more or less cash or something like that. And then we'll go one by one through each of the holdings in the portfolio and talk about how each of them performed, what percentage each of them make up, and any news sort of surrounding that stock in the past month. And then of course, towards the end, we'll go through the total portfolio performance for the month and compare that to the S&P 500 and the Australian All Ordinaries. And of course, we'll break it down into capital gains, dividends, and currency, so you can see exactly how much I made in the market in this month. So if you do enjoy the video, please leave a like, and of course, if you're new around here, hit subscribe. But let's jump into it. So I always like to start by going through my asset allocation, which is essentially where we talk about what assets I'm holding, what are the different types of assets I'm holding, and what percentage of each of them am I holding. And every single month this year, and ever since I've been doing this series, I've held two types of assets, that being equities or stocks in the market and cash. And the reason that I just hold those two is because I like to keep my portfolio as simple as possible. There are many other things I could do. I could hedge my portfolio with bonds or with gold or other commodities, or some other kinds of sort of derivatives, maybe some options trading or something like that. But I just like to keep it simple. My investments in the stock market are a bet that the market's going up, and my cash on the sideline is my bet that the market could go down, so that if it does, I can use that cash and buy those stocks at cheaper prices. So let's first have a look at what my positions were last month. So as of last month, I had 47% in cash and 53% in equities. And that's changed quite dramatically to April, where I now have 54% in cash and 46% in equities. So my cash position changed by about 7%, or increased by about 7% in the past month. And there's really two factors that contributed to this. One factor that reduced my cash position slightly, and then the other factor which massively increased my cash position. So the first reason that sort of reduced my cash position was that, of course, my equities were up for the month. So if my equities were up for the month, it means that the equity proportion of my portfolio increased in size. And that what the effect would do is it would shrink the cash relative to the equities. However, that factor was overwhelmed by another factor, which was that when my income came in, I didn't invest any of it in the stock market, and I allowed it to build up. And as a result, my cash position grew relative to my equity position, even though the equities were up for the month. And towards the end of the video, I'm going to be sharing with you why I have so much cash on the sideline. I never like to have an overwhelming amount of cash on the sideline. I don't think that, what am I at, 54%? I don't think 54% is an overwhelming amount, considering where we are in the economic cycle, but I still don't like to have huge amounts such as 54%, but I am using that cash for something, and I will talk about that towards the end of the video. But with that said, we should just get straight into talking about some of the individual stocks in my portfolio, all of them actually, and we'll go through each of them, see how they've performed, and talk about any news that sort of surrounds those businesses. So the first business we've got is NAB, and NAB stock makes up about 3.9% of my portfolio, and that's down from 4.6% that it was last month. And the reason for this is that the stock is up 1.3%, but which means that the total size of the NAB position increased, the amount of the value of it increased, but the percentage decreased because it only increased by 1.3%. And there was other businesses in my portfolio that increased at a higher percentage, and that resulted in this becoming a smaller piece of my portfolio. And if you've seen any of my other investment portfolio videos, you would know that this is a stock that I purchased. I think it was my very first investment or second investment. And I've just held on to it all this time. It's a very small part of my portfolio, just 4%. And I will be looking to offload that and move that money into another business, probably in the near future. But for now, it's just going to continue to become a smaller part of my portfolio as I continue to put more of my income into the market. So my second stock, the second smallest position in my portfolio is YY Inc. And this is a Chinese online streaming service. It's traded on the US market, but it is a Chinese company. And this stock makes up 5.5% of my portfolio. And again, that is down from 6.5% a month ago. So in the past month, again, YY was a positive stock for me. I think all of the stocks were up in my portfolio this month. YY was up 2.28%, and it's pretty similar story to NAB. The size of the value of the position increased, but the percentage decreased because there was other stocks that increased at a higher percentage during the month, and we'll get to some of those. I'm sure some of you know what's coming, and the next stock is Facebook stock. So Facebook had their earnings come out, and their earnings were liked by Wall Street and the fund managers who piled a lot of money into the stock and sent it shooting up. So Facebook makes up 8.1% of my portfolio, and that's down from 8.7%. And the stock is up in the past month 16.8%. So Facebook has done very well for me in this month and contributed a large amount to the increase in my portfolio in April. So as I just said, Facebook released their first quarter 2019 results. So I thought I would just briefly go through some of the results because I don't plan on making a video on it just because there are so many earnings coming out, and I'm going to be making some videos on some of the other earnings. So Facebook's daily active users and monthly active users grew during the month. Daily active users reached 1.562 billion, which was up 8% year over year. So they're still massively growing their user base, and their total users, meaning how many people use at least one of their platforms, whether that be Facebook, Messenger, Instagram, WhatsApp. As long as someone uses one of those platforms, they are counted in this number, and that number is 2.7 billion users, which is astonishing. It's almost or just over 1/3 of the world population, which is just incredible that they have a company that their platform is that big, to be honest with you. And that has continued to lead to increases in their revenue, which was up 26% year over year to 15 billion. Their income from operations were up 13% year over year to 3.32 billion. Net income was up 2.4 billion to up 11% to 2.4 billion year over year. And all of those numbers that I just mentioned actually excludes a $3 billion legal fee. So that's just a one-off fee. If you take that out, then they grew. But if you include that legal fee, then they didn't grow in many categories except for revenue. And that legal fee is basically money that they've set aside for a fine that they're expecting to get. That's a fine that's supposed to be somewhere between $3 and $5 billion. From the US government, which is pretty incredible that they're going to experience such a big fine. And this is the sort of in a similar position to YY. I'm not adding to this stock because I consider it a speculative play. And I considered that from the start of when I invested in this. It was just, I was going to put a small amount of money in it. At the current time, it's about 8% of my portfolio. So put a small amount of money in there, and I'm not going to be adding more to this position anytime soon. I don't think. I will just let it run and just see what happens with it. And I'm happy to hold this over the long term because I still think that Facebook is a great business. The reason it's speculative to me is that I don't accurately know if I can calculate their cash flows. And of course, there is a lot of uncertainty around social media businesses beyond, say, 5 or 10 years. So we really don't know how successful they'll be beyond that time. But for the time being, they have almost $50 billion in cash, and they've consistently made very high return investments. So it's only a matter of time before they can put a lot of that cash to use, find some high return investments, and compound and continue to compound their revenue and their income over the next 5 or 10 years. My second biggest position in the stock market is my index fund, which tracks the top 300 companies in Australia. That's the VAS, Vanguard Australian Shares Index. And this one makes up 13% of my portfolio, which is down from 14.6. And the Australian index was up 3.4% in the last month. So the US and the Australian markets were actually up quite a lot in this month. And that obviously contributed to my portfolio increasing directly through this index fund and indirectly through the individual stocks also increasing quite dramatically. And again, there's nothing really to say about this index fund. I'm trying to keep it between 15 and 20%. So if it drops a little bit further down to maybe 10%, then I will bump it back up to 15 or 20%. And I like to just keep it in that range because it's a nice foundation of my portfolio that will very likely go up at somewhere between 6 and 10% over the long term, regardless of how my individual stocks perform. So it's a little bit of a safety mechanism where I still have money invested, but I'm not at the mercy of the individual picks that I've chosen for that part of my portfolio. And my last position, my biggest position, is of course Thor Industries, and Thor Industries was up big for the month. It was up 11.6%, so a great month for Thor Industries. And Thor Industries makes up about 15.8% of my portfolio, which is down from 18.5%. So Thor Industries had a terrible 2018, coming off its highs, and then we started to see that the RV industry started to turn down. They came off a massive year in 2017, and 2018 just couldn't compete with that. And now in early 2019, they've had acquisition costs, and they're trying to synergize their new business, Erwin-Hymer, into the Thor Industries business, and that comes with a lot of sort of startup costs to make that merger work, and that's resulted in their profits, their sales and their profits being considerably lower around this time, and that resulted in their stock actually from their very top. If you take it from their very top, their stock fell almost 70%, which is pretty substantial if you ask me. And based on that drop, I saw the opportunity to buy some shares at a price that I thought could offer me a pretty substantial return over the long term. And over the past few months, they've started to recover and move in a higher direction. Where Thor will go in the short term, I'm not sure. It will depend if we have a recession or not. If there's a recession, it'll keep coming down, I would say. If we don't have a recession in the near term, it's likely that it could move up quite quickly because the recession headwinds was one of the major problems. Tariff problems, that's really been sort of mitigated by now. There's not really a problem, increased costs there. And now they have this acquisition, which is going to dramatically increase their profitability. So Thor Industries will be an interesting one to watch. I may add to the position because it's now only 16% of my portfolio. So I may be adding to that one. But as I said, I will talk about what I'm doing with my cash elsewhere because I do have a sort of better investment opportunities somewhere else. So let's now talk about the portfolio performance as a whole. And of course, I like to break it down into capital gains, dividends, and currency gains so you can see exactly how much my portfolio increased in the month of April. So capital gains was 6.55%. Dividends was 0.66% and currency gains was 0.71%, and that led to an overall gain of 7.92%, and that's for the equity proportion of my portfolio. So if you include the cash position, that would reduce the return that I made in the past month to 3.7%. And if we compare that to our benchmarks being the S&P 500 and the All Ordinaries, the ASX 500, the S&P did 3.7% for the month, which is a massive month, and the ASX 500 did 2.8%. So my portfolio outperformed both of those, even if you include my cash position, which is pretty impressive if you ask me, because I have 55% of my cash, of my money just sitting in cash, really not doing anything, earning 2%. Actually, that doesn't even include the 2% that my cash earned, so I definitely did outperform both those indices. But what I would say is that it's better for you to look at it. It's a more accurate picture to just look at the performance on the equity positions and not the cash position. And I'll tell you why. It's because my cash position isn't just sitting there in cash doing nothing. I mean, technically it is right now, but I am investing a significant amount of that cash in my own business. And at the moment, for the past few months, I've been able to invest $1 for every dollar that I've invested into my business. I've produced $4 back within a couple of months. So that's a substantially higher return than what I can get in the market. In fact, for the stocks that I'm looking for, I'm looking to make between $4 and $8 back for that $1 over 10 years. And I was able to do that within a couple of months with my business. So it's not a fair, accurate picture to say that my cash is doing nothing, because technically at the current time it's just sitting there, but over the next few months, a significant amount of that is going to be invested, and it's going to generate a significant amount more money on top of it than I could in the market. So that's why I have such a high amount of cash. Sometimes people ask me, does it really make sense to have so much cash on the sidelines when you can't find businesses that are offering you 15% or more safely with a 15% margin of safety? And I would say you can do whatever you want with your money, but you need to calculate what return you're going to get. And for some of the stocks right now that I understand that are on my waiting list, I can get maybe a 10 to 12% return with no margin of safety, or maybe a 15% return with no margin of safety. And for some of the other businesses, they're only offering about 7 to 10% with no margin of safety. So you can invest in businesses like that if you don't want your cash on the sideline, or if you have too much cash on the sideline. But that's the return you're going to get. If you don't wait for that 50% drop in the stock prices, or 30% drop in the stock prices, then you're not going to be able to be confidently getting a 15% return in the market. And there's no reason for me to do it, because why would I put my money into the market to get a 10% return with no margin of safety, meaning I may or may not get it, when I can put my money elsewhere and make 400% in a couple of months? So that's sort of just my current portfolio and current situation, so that some of you understand how my situation may be a little bit different to yours. But regardless of whether or not I had my business, I would still be keeping a decent proportion of money on the sidelines, because of course prices are very high, and I expect that in the near term, we will see an opportunity where we can buy stocks at a substantially lower price. Whether that happens quickly over a year with a quick crash, or whether that sort of extends over a number of years and we just see the market decline for the next 10 years like we did in 1937, which was the recession after the Great Depression. But I hope you guys enjoyed this video, and if you did, of course, leave a like and hit subscribe if you want to join the team and become a member. But I hope you guys have a great day, and I'll see you in the next one.